Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. Today, we're embarking on a real deep dive. We're pulling the most impactful insights from the biggest stories shaping our financial world right now. Our mission really is to dissect the headlines that are moving markets, moving economies, and give you those essential aha moments. So you feel not just informed, but, truly well-versed. We're drawing from top sources today: Reuters, CNBC, Bloomberg, Yahoo Finance, aiming for that comprehensive, balanced look at the global financial landscape.
Absolutely. And as we unpack these stories, what really strikes me is just how interconnected everything is. Think about it. A court ruling for one tech giant, which we'll get into, it sends these huge ripples through related sectors, affects competition, innovation, everything.
And global bond yields. They might sound abstract, right? But they directly influence borrowing costs. For governments, sure, but also for businesses and even your mortgage. And political decisions, tariffs, challenges to the Fed, they have immediate, very real market consequences. So understanding these complex currents isn't just about knowing what's happening. It's critically about why it matters and how these seemingly separate things weave together. That's the key.
That interconnectedness is definitely the theme today. So let's kick things off with that monumental piece of tech news, the one that sent, first shockwaves and then surges through pre-market. We're talking Google parent Alphabet. Their shares, according to Reuters, CNBC, Yahoo Finance, they surged, what was it? An incredible 6-8% this morning. This sounds like a huge win for them. What were the key parts of Judge Mitha's ruling? The parts that spared Google from, the really severe outcome the DOJ wanted in this big antitrust case?
Yeah, it was definitely seen as a significant win, a massive relief for Google, really. The core of it, basically, is that Judge Meta allowed Google to keep control of its Chrome browser and its Android mobile operating system. And that was a huge point of contention. The DOJ had actually proposed divestiture for Chrome, a structural breakup.
Right.
But the judge specifically pushed back against those most severe consequences. He even pointed to new things like AI tools, ChatGPT, as emerging competition in search. And what's also really crucial, Reuters highlighted this, is Google can keep making those massive payments, billions, to partners like Apple, to be the default search engine. That practice was explicitly called central to its dominance in online search. MoffettNathanson analysts, they were quoted everywhere, Reuters, CNBC, they summed it up perfectly, called it a home run for the status quo.
Yeah.
They even added something like being found guilty of monopolistic behavior, yet facing such a benign remedy is particularly favorable for Google.
A home run for the status quo. That really captures it, doesn't it? A major win, but maybe not a radical change. But you mentioned benign remedy. It wasn't a complete free pass, though, was it? The ruling does stop certain exclusive deals and makes Google share some data. How significant are those caveats? Do they actually help competitors, or is it more like window dressing, given the home run?
That's a really important distinction. Yeah, it wasn't a total walk in the park. While it prevented that breakup, the ruling does impose behavioral changes. So Google is barred from certain exclusive contracts that, condition payments or licensing on exclusivity. And significantly, Google will have to share certain search index data and user interaction data with rivals. Not its ads data, though, and it's supposed to be on ordinary commercial terms. So while it's not that structural overhaul the DOJ wanted, these are still meaningful operational constraints. But what this really shows, I think, is how antitrust is evolving in this digital age. Instead of breaking up these huge integrated tech giants, which is incredibly complex, potentially disruptive regulators seem to be leaning more towards these behavioral remedies. It kind of acknowledges the complexity, the difficulty of unscrambling the egg without, unintended consequences. Sets a bit of a precedent, maybe.
That's a great point about the shift towards behavioral remedies. It makes sense, given the complexity. And the ripples hit Apple immediately, didn't they? CNBC reported their shares jumped, 2.6 to 4% pre-market? Seems directly linked.
Oh, absolutely.
MoffettNathanson analysts are even saying this keeps the door open for Alphabet to deepen its partnership with Apple, maybe even integrate Google's Gemini AI into future iPhones. So this isn't just legalese. It's about how two of the world's biggest companies operate, innovate, affects how you search on your phone, potential AI in your next device. It's huge.
Definitely.
Okay, that tech antitrust dive really sets the stage for that interconnectedness you mentioned. And speaking of broad forces, let's zoom out a bit. Look at the wider global markets. They've been under, quite a bit of pressure lately. It's been mixed globally. U.S. equity futures were mostly up Wednesday after that Google news, which helped. But Tuesday saw the Dow, S&P 500, NASDAQ all slip. Profit-taking in big tech, yeah, but also Tara Horry's Fed concerns. Jim Cramer on CNBC pointed those out. Asia-Pacific was mixed overnight. Europe, though, opened higher Wednesday, kind of reversing some recent negativity about fiscal issues. What's driving this sort of underlying anxiety, would you say?
You definitely hit on the key source of that anxiety.
Mm-hmm.
It's largely centered on the bond market. Bloomberg's talking about renewed selling pressure in global bonds. It reflects these widespread jitters causing some really big moves. We've seen Treasury yields climb. U.S. 30-year debt is getting close to that 5% mark.
Mm-hmm.
Psychologically important. In the U.K., 30-year yields hit their highest since 1998, 5.75%. Japan's 20-year notes, highest since 1999 at 2.695%. Their 30-year hit a record high, 3.286%. CNBC reported those.
Records. Okay.
So what's driving this big synchronized surge? It's really a mix. Concerns about inflation sticking around, heavy government debt sales flooding the market, a feeling maybe of a lack of fiscal discipline in major economies, and just general political uncertainty. Deutsche Bank's CEO, Christian Sewing, Bloomberg quoted him saying emphatically, "I don't think this is just a flare-up." He sees it reflecting political uncertainty, of a lack of reforms, of rising indebtedness.
Not just a blip, then.
Exactly. And this environment is also boosting demand for things called steepeners. Those are strategies betting on the gap widening between long-term and short-term bond yields, essentially betting longer rates rise faster.
That Deutsche Bank quote really frames it as something more systemic, not temporary. So this synchronized jump in global bond yields, it feels like more than just an inflation scare, right? What's the deeper takeaway here beyond just, okay, borrowing costs are up?
Exactly right. It's more profound than just inflation jitters. It's really a stark signal, I think, that markets are, let's say, losing some faith in government's fiscal discipline across developed nations. It suggests we might be entering an era where the cost of public debt becomes a serious drag on economic growth for years. For you listening, it means thinking about higher borrowing costs, potentially filtering down to everything. Corporate debt, sovereign debt, eventually consumer credit, mortgages. It's a fundamental rethink of risk and return.
A fundamental recalibration. Okay. Now, amidst all this volatility, this rising cost of debt, one asset has been absolutely shining: gold. Yahoo Finance says gold hit another all-time high, $3,546.96 an ounce. That extends a 6-day rally. It's up almost 35% year-to-date in 2025. That's pretty remarkable. What's fueling this seemingly endless demand, and is there something deeper going on with central banks buying it up?
Well, the gold surge has a few drivers. Analysts, like Nick Lawson from Oceanwall, point to a combination. One is the prospect of U.S. interest rate cuts. That makes gold more attractive because the opportunity cost of holding a non-yielding asset goes down, you see.
Right.
But crucially, there's also increased haven demand. That's driven by all those worries we just talked about. Sticky inflation, uncertain growth, geopolitical tensions, and yeah, those budget concerns in developed nations. But the central bank angle, that's particularly telling. Here's a fascinating fact from CNBC. Central banks now hold more gold than U.S. Treasuries for the first time since 1996.
Wow, since 96.
Yeah. This isn't just a tactical adjustment. It feels like a strategic shift. Diversify away from traditional reserves, hedging against potential systemic risks, maybe even, a quiet de-dollarization trend among some countries. It reflects, I think, a deep-seated concern about the long-term stability of the global financial order.
That is a fascinating shift, potentially profound. Okay, let's pivot now to the political economy. Former President Trump is definitely back in the headlines over trade. According to CNBC and Yahoo Finance, he's pushing for an expedited ruling from the Supreme Court, trying to overturn that appeals court decision that found most of his tariffs illegal. He used some strong language, claiming an economic emergency, saying without tariffs, the U.S. could become a third world country. He even blamed Tuesday's market dip directly on that ruling, said the stock market's down because of that. What are the actual mechanics here? How serious are the potential financial ripple effects if the Supreme Court doesn't overturn the appeals ruling?
Okay, so the core issue, as Yahoo Finance laid it out, it is significant. It carries real financial weight.
Yeah.
If the Supreme Court upholds the appeals ruling, meaning the tariffs stay illegal, the government might have to refund billions, literally billions, in collected tariffs.
Billions, okay.
And that's not just an accounting headache. It could force the Treasury to issue a flood of new government debt, selling more Treasury securities to raise the cash for those refunds. That sudden extra supply could push up interest rates, stress financial markets. It really highlights that delicate link between trade policy, the courts, and fiscal stability. But it's important to add nuance. While it's serious, economists generally are not predicting, a 1929-style crash, despite some of the rhetoric.
Goldman Sachs analysts actually suggested that even if the Supreme Court takes the case normally, not expedited, the tariffs could stay in place until maybe June 2026. Plus, even without these specific tariffs, Trump can use other laws for sectoral tariffs on steel, aluminum, cars, things like that. So the broader trade uncertainty, that's probably not going away soon.
Okay, so the immediate financial earthquake might be less likely, but the long-term trade uncertainty just lingers. That makes sense. And the global impact of these tariff fights, it's really varied, isn't it? Take India. CNBC reports they're facing steep U.S. tariffs up to 50% on most imports. But analysts think stronger domestic growth, maybe helped by reforms and rate cuts, could soften the blow. Still risks, though, like a weak rupee.
Right.
Then in Europe, chemical makers are feeling the strain, customers delaying orders. But then you have a company like Watches of Switzerland, as CNBC noted, basically shrugging off a 39% tariff on Swiss imports, saying they're on track despite it. It's such a mixed bag. What does that tell us about how effective or maybe how unpredictable these protectionist policies are in today's world?
These examples show it perfectly. Protectionist policies rarely hit evenly or predictably. You see India potentially managing because of strong domestic factors shows the value of internal resilience.
Then European chemical makers feel immediate pain, showing how tariffs mess with global supply chains and pricing. And then Watches of Switzerland, luxury goods, seemingly unaffected. Maybe inelastic demand, maybe brand power. What it tells us is, look, tariffs are meant to protect domestic industries, but the real-world effects, often uneven, creates winners and losers in surprising ways. Often means higher costs for consumers or hits exporters' competitiveness. For you listening, the takeaway is clear. Tariff policy isn't abstract. It directly hits prices you pay, companies you might invest in, the whole global flow of goods.
A powerful reminder of the complexities. Absolutely. And speaking of political influence on economic institutions, something else is brewing. Bloomberg reports a legal fight that really highlights challenges to the Federal Reserve's independence. Fed Governor Lisa Cook's lawyers are fighting President Trump's attempt to remove her. They're calling his mortgage fraud claims cut-and-paste allegations, basically aimed at getting rid of someone he disagrees with on policy. This isn't just politics as usual, is it? What's the bigger significance here for the Fed's, near century of independence? How could this affect market confidence?
No, this is profoundly significant. Precisely because it's not just a political spat. It hits right at the core of the central bank's independence. The Fed's ability to make policy decisions free from political interference, that's seen as vital for market confidence, controlling inflation, economic stability. This challenge from President Trump underscores those ongoing tensions you sometimes see between administrations and the Fed, especially when the Fed is reluctant to cut rates if the economy doesn't warrant it. Historically, that independence has been a pillar of credible monetary policy. Any sign that it's eroding, that could spook markets, heighten volatility, raise worries about political meddling in rates. Ultimately, it could damage trust in the Fed's ability to manage the economy impartially. It really raises serious questions about navigating future crises without political sway.
Preserving that trust is critical. Okay. Moving into corporate strategy, emerging landscapes, we find something, kind of unexpected, a surprisingly deep dive into cryptocurrency by the Trump family. Reuters detailed their growing footprint. It's pretty diverse. Trump Media holds Bitcoin, partners with Crypto.com for CRO tokens. There were even those Trump and Melania meme coins launched. They surged initially, then, slumped pretty hard.
Right, the meme coins.
Beyond that, there are NFTs, plans for U.S. Bitcoin mining backed by Eric and Donald Jr., even talk of crypto ETFs for Bitcoin, Ethereum, Solana, XRP. What does this tell us about the state of crypto right now, and maybe the blurring lines between politics, branding, and pure speculation?
Look, this whole situation is a fascinating snapshot of the crypto world today. It tells us the market has definitely moved beyond its early niche. It now attracts figures who really understand branding, cultural relevance, how that can drive value. Now, some ventures, like Bitcoin mining, that's more like traditional infrastructure investment.
Sure.
But the meme coins, the NFTs, they perfectly illustrate that speculative, highly volatile side of crypto, where personality or cultural buzz can drive value just as much, sometimes more, than any traditional fundamental.
For you, it's a stark reminder. Crypto offers innovation, yes, potential, yes, but it also carries huge risks. It operates in a space where hype and sentiment often trump established financial metrics. It really underscores those blurring lines, politics, branding, speculation, all mixing together in the digital asset world. A sharp observation on brand power there. Okay, shifting gears again, but sticking with critical sectors, semiconductors. The U.S. is tightening its grip on policy here, according to CNBC. They've revoked validated end-user status, VEU status, for big chip makers like TSMC, SK Hynix, Samsung, for their plants in China. What does that mean practically for these companies, and what's the bigger strategic goal, especially since we saw some easing of controls earlier?
Yeah, this is a pretty significant move in that ongoing U.S.-China tech rivalry. Revoking VEU status basically means that shipping U.S. origin chip-making tools to those specific facilities in China now needs an individual export license for each shipment.
Okay, more hurdles.
Exactly. Practically, it makes it much harder, definitely more bureaucratic, for these companies to produce advanced chips inside China. The strategic goal seems pretty clear. Slow down China's ability to boost its own local chip production capacity, especially for advanced stuff, and reduce its reliance on foreign tech know-how.
It's interesting because, as you said, it contrasts with some earlier easing of controls on certain U.S. AI chip exports, think NVIDIA, AMD to China. That earlier move was more about allowing less advanced chips through. This VEU change is about stopping the core manufacturing capability from being built up. So it shows a nuanced strategy, but still firm, controlling key tech at the foundational level, big long-term implications for supply chains, the tech Cold War.
The semiconductor strategy is definitely complex and intensifying. And speaking of shifting strategies, sustainability. It's really becoming a core factor in big investment choices, not just talk anymore. We have a concrete example from Reuters. PFZW, the big Dutch pension fund, Netherlands' second largest, $250 billion in assets. They ended their relationship with BlackRock. This isn't small potatoes. It was a clash over sustainability. What was the specific issue there? And what does it say about the growing power of these big institutional investors pushing for ESG?
Yeah, this is a pretty big deal. Sends a clear signal across the whole asset management world. PSEW basically cited BlackRock's reported reluctance, let's say, to consistently support sustainability resolutions at shareholder meetings. And that clashed directly with PFCW's own stated goal, finding a better balance between returns, risk, and sustainability. For them, it wasn't just about the bottom line. It was about alignment with broader goals.
Makes sense.
So what this highlights is that growing pressure on huge asset managers like BlackRock. It's not enough just to offer ESG funds anymore. These big investors, especially pension funds with long horizons, they want managers to actively use their voting power to push companies towards more sustainable practices. They're demanding accountability, a more proactive stance. This move could really signal a trend where managers get judged not just on returns, but on their real commitment to sustainability principles.
Fascinating. ESG moving from buzzword to a deciding factor. That's significant. Okay, beyond these major shifts, just a couple of other corporate moves that caught our eye. Kraft Heinz, expected to split into two companies by late 2026. That's a big deal, especially since Warren Buffett, whose Berkshire Hathaway kind of put the merger together, reportedly found the news disappointing. CNBC noted that. What does Buffett's reaction tell us?
Well, Buffett's disappointment is pretty telling, isn't it? It kind of reflects the inherent difficulties of these mega mergers, especially integrating diverse brands, different cultures. Kraft Heinz, formed back in 2015, aimed for scale, cost savings, but they've really struggled with growth, changing consumer tastes, staying relevant. Buffett's reaction sort of underscores that even with smart strategy, lots of capital, making these huge integrations work in a fast-changing market is just incredibly tough. Bit of a cautionary tale, maybe. And also, quickly, Tesla. Elon Musk claiming most of its value will eventually come from Optimus, the humanoid robot. CNBC highlighted that. Comes right as Tesla is facing a sales slump, kind of lagging in robotaxis. Classic Musk, perhaps, pivoting to a big, futuristic vision when the core business faces challenges. Shows the speculative bets some companies make.
Okay, let's try and unpack all of this. Today's deep dive, it really showed how fast things can shift, didn't it? From court rulings hitting tech giants like Alphabet and Apple to global bond markets just reacting instantly to political wins and changing feelings about fiscal health. And here's where it gets really interesting, I think. We saw these powerful, often linked forces, antitrust law trying to adapt to digital giants, global trade policies like tariffs creating these uneven ripples everywhere, the growing importance of sustainability actually driving huge investment decisions, political figures jumping into speculative crypto markets, and that crucial need for central bank independence to maintain stability.
Right. So what does this all mean for you, the learner, trying to navigate this incredibly dynamic world?
It really raises an important question, I think. As technology, politics, finance get more and more tangled up, how much will future market stability, future economic prosperity really depend on finding that balance between fostering innovation, applying smart regulation, keeping fiscal houses in order, and genuinely committing to broader values like sustainability and institutional independence? What stands out to you and how all these forces are shaping our economic future right now?
Thank you for joining us for this deep dive into today's headlines. We'll see you all tomorrow morning with new headlines from major financial magazines.